Now we will learn about the accounting for finance leases. You just learned about the lease classification tests, and there are 5 tests. If any lease agreement would meet one of these 5 tests, we will classify as finance lease. And you will see in real world, most of the leases will meet one of these tests. And here, for these finance leases, we will learn both parties' accounting treatment. Let's focus on first Lessee's side, and we'll use the same example both for lessee and lessor. So let's do the example, and first we will do this classification test, and then we will record the lease payments, and we will also learn not only the journal entries but also how to prepare an amortization table. Assume that Coffee and Beans Equipment, who is the lessor, and Starbucks, who is a lessee, signs a lease dated January 1st, 2025, and to lease a commercial grade roasters to Starbucks beginning January 1st, 2025. So, lessor is Coffee and Beans Equipment, who has a commercial grade roaster, and Starbucks is the lessee who will be using that roster. And the lease started on January 1st, 2025. Lease terms are non-cancellables, and you will see the terms here. Lease term 5 years, no renewal options. Rental payment beginning of each year. This is the yearly payment that they will do for 5 years, and it is made at the beginning of the year. When you have any installment or payment, whether it's monthly or yearly, we call it an annuity. And if this annuity or this installment or payment is made at the beginning of the period, we call it annuity due. And if the installment or the payment is made at the end of the period, no matter it's a month or year, we call it ordinary annuity. So you will see all examples the textbook uses. Payments are made at the beginning of the period, and all will be annuity due. Why these are important? Because depending on whether it's an ordinary annuity or annuity due, whether the installments or payments are made at the beginning or at the end, you have to use the correct factors to figure out the present value. Now, what is the leased asset? So the leased asset is the bean roaster, and you will also see the fair value of the lease asset is $100,000, and the life is 5 years, and it also have residual value which is guaranteed $5,000. It's also probable that the expected residual value will be greater than this guaranteed residual value, and the equipment reverts to Coffee and Beans. That means there is no option that Starbucks will buy it or keep this. So at the end of the term, Coffee Beans will get back their roaster. Starbucks borrowing rate is 5%, and it uses straight line depreciation. Coffee Beans annual rate of return is 4%. These rates are important to calculate the present value, and you will see for most of the leases, for lessee's perspective, for financial borrowing cost is usually higher compared to the cost that they have to pay through the leasing, and this the rate is determined based on lessee and lessor, and then mostly it's based on the lessor's rate. So we will use 4% rate to calculate the present value, and I'll also show you how we can use the present value table. Now let's see how we will do the test. So there are 5 tests. Transfer of the ownership test. Did this contract meet the transfer of the ownership test? No, it does not. This transfer of ownership test didn't meet because the asset will be reverted to Coffee and Beans. The asset will not be with Starbucks end of the term, or will be purchased by Starbucks. Purchase option test. Yes, Starbucks will not purchase the asset. We didn't see any information there in the lease terms. So first 2 tests didn't meet. How about lease term test? The lease term test, if you see in the previous slide here, that the lease term is 5 years and the life of the roaster beans are also 5 years. That means the lease term test is met here and 100%. Starbucks or the Lessee will use the 100% life, and you remember the threshold is 75% or more. How about the present value test? And you remember the threshold, the present value of the lease payments of all lease payments and future values will be 90% or more than 90% of the fair value of that asset at the beginning of the term. So now if you see the future payments, they will pay this, all those for 5 years, 20,711, and this will be made at the beginning of the year, and then there is also a residual guaranteed value 5,000. So if you calculate the present value, then we will compare it, what is the fair value of the roster at the beginning of the lease term. And if we see the present value of all these payments are 90% or more than that, then we will see, okay, present value test is met. So now here you will see the textbook also did the calculations. So 20,711, this is their yearly payment, and we use the present value factor. So you will be given this table during your quizzes or your exam. You can use a calculator in Excel. You can also do that, but for the test and exercise purpose, we will be using a table. And if you take the present value factors from the table is also posted on Blackboard. I can also show you. Let me finish this slide. And then you will multiply with the present value of annuity factors, 5 years 4%, which is 4.6299 multiplied by 20,711. This is the present value of 5 yearly payments. And then there is another guaranteed residual value 5,000. So this is a lump sum factor. We will also calculate the present value. Look here. When you calculate the present value or do the present value test, we include the guaranteed residual value. And after taking the present value of these two types of payments, you found that the present value of all future payments, lease payments, is 1 million, which is actually equal to this fair value of that asset, which is also 100 million. Of course it's equal, and of course it's greater than 90%, so we will see that the present value test is met. Now if you use these factors, and you will see that 2 cents difference just because of the rounding factor. If you do it in a Excel sheet or take more digits after the decimals, you will see it will be perfectly matched. So it is rounded by 2 cents. Now I will show you how to use the present value table, and then we'll come back to the rest here. This is the present value table I already posted on Blackboard, and I'll also give you during the exam. So these present value factors, I'll also mention it during the test, so you don't need to do anything with it. If you don't have any financial calculator, don't worry. If you don't have the print copy, don't worry. So now here, let's see, this is the present value of $1. That means a lump sum amount you will receive in future. What is the present value now? So if you remember the residual amount, that is at the end of the 5 years, and we will use 4% rate, coffee and beans internal annual return rate. So now if we look at here the table, so let's see 5 years and 4% rate. So you will see here for $1 present value factor is 0.82193, and to get the present value of the residuals, which is $5,000, we multiplied it $5,000 by 0.82193. This is how you calculate the present value of a lump sum amount. Now, how about the present value of annuity? I told you earlier, this type of fixed payments or installments are known as annuity. Now, if the payments are made at the end of the period, we call it annuity, ordinary annuity. If the payments are made at the beginning of the period, we call it annuity due. All of these examples the textbook made under the exercise problems, you will see is mostly annuity due, or the payments are made at the beginning of the period. So you look at the annuity due table. So you remember the coffee and beans and Starbucks example that we are using. They have rental lease payment for each year 20,711.11, which is made at the beginning of each year, and it's for 5 years or 5 installment. And if you take the coffee and beans rate, which is 4%. So now for $1, if your annuity amount is $1, let's see the factor, the present value of annuity due factor. So it's for 5 years. This n is the number of periods or years, n. And then here, if you look at the 4% number, which is 4.62990, and you will see that when we calculate calculated the present value of all those rental payments, we use this number 4%, 5 years, 4.62990. This is how you will be using your present value factors to calculate the present value, because you need to do the present value test for identifying whether it's a finance lease or it's an operating lease. Now you learned how to calculate the present value, how to use your present value table. The last test is alternate use test. So here it seems that the coffee roaster will go back to coffee and beans, and it's more likely that other party can also use it and make another lease contract. So that means the coffee roaster still has some alternate use, so alternate test is not met. So this is how we did the lease classification test. Only 2 tests are met: lease term test and present value test. No matter what's the number of the test you made, if it met one of these tests, then we will consider it as a finance lease. Now let's see from lease's perspective how we will record it. For a finance lease or even for an ordinary lease, the lessee needs to record the lease asset on their balance sheet, and of course the lessee will record the lease liabilities on the liability side. Now when the lessee will record the asset, the lessee cannot just call it their simple regular asset. Rather, the lessee will use this title, right of use assets. And how the lessee will determine the amount here, and how the lessee will also determine the lease liability amounts that they will capitalize based on the payment over the period of the lease terms. It is based on the present value of the lease payments. Remember, when you did the present value test, you included the both, all those rental payments and the residual value, but for determining these lease liabilities, and which is also equal to the right of use assets, we will only consider the lease payment, no matter is the monthly payment or the annual payment. So we took the $20,000 711 and then we multiplied by this present value of annuity due factor, which you know how to do that. So this will be the amount 95,890.35 that the lessee will record as a lease liability, and also on the balance sheet asset side will record as right of use assets. Now here the lessee will not pay the residual value. So also there is no guaranteed fixed amount. There is also unguaranteed part, because the residual value might be higher. It's more likely that. So that's why we will consider only the annual lease payment to calculate the lease liabilities. So now we will see how the lessee or Starbucks will record the journal entries. So on January 1st, based on the lease liability amounts, the lessee will debit right of use assets, balance sheet side asset, balance sheet item asset side, and lease liabilities, and it will go to their liability sides. Remember, those are all long term. Now on the 1st January 2025, right after signing the contract, on the very first day, first payment is made because it is made at the beginning of the period. So the lessee paid the first payment or first installment. Cash is credited 20,711.11, and then lessee will also reduce lease liabilities by the same amount on the very first day. On that same day, they recorded the lease liabilities. Now you will learn how to prepare the amortization schedule or amortization table. This is very important to learn, and we will be a small amortization schedule, maybe 3 years or 5 years, and please learn it by hand. So here you will see that on January 1st 2025 the lessee calculated the lease liabilities. That is, on their liability side also the same amount is shown as an asset on their asset side. Now here on the very first day the first payment is made. So when the first payment is made, so this liability portion is also reduced by 20,711. So this is the liability they created first, and they subtracted the first payment. So right after making the payment, the remaining liabilities on the first day, January 1st, 2025, is 75,179.24. Now what happened? Here 1 year passed. Assume that it's December 31st, 2025, although the table shows January 1st. Of course, this is the day the second payment will be made. Now remember, based on this last year's amount, the lessee will calculate interest rate, 4% interest rate. So if you take this liability amount, once you made the first payment at the beginning of the year, for the whole year your liability amount was 75,179.24, and if you calculate 4% interest on it, the interest amount will be $3,007.17. So now what we will do, we will look at the annual lease payment, which is fixed. So the lessee made the second lease payment on January 1st, 2026, 20,711, and out of that payment, $3,007 is for interest expense. So if we subtract this $3,007 from this installment, the remaining amount will be towards the payments of lease liabilities. So if you subtract 3,007.17 from 20,711.11, the remaining portion is reducing your lease liability. So your lease liability was 75,179.24, and if you subtract that liability that you are paying from second payment, it will be here 57,475.30. So this is how you will make every year. At the beginning you will make the lease payments, but make sure that previous year's amount you count the interest rate, then subtract the interest amount from your fixed installment, and the remainder will cover your liability payment. And after subtracting this liability payment portion from previous year's liability, you will find what is your liability now this year. And now if you do it, you will see you may have like few cents difference just because of rounding figures. So this is how you will prepare the amortization schedule. You will see also the steps are there. Now how the journal entries will look like. So December 31st, Lessee or Starbucks will record the interest expense payment. Remember here, for the first year, they counted interest expense 4% on the remaining liabilities 75,179.24. So 3,007.17 is paid because of the interest expense. So they will debit interest expense, that amount, and then the other part they will credit as lease liabilities. So now here we will also do one more journal entry, which is the amortization expense. So remember this amount right of use assets. This amount is currently on the asset side, and Starbucks uses straight line, and Starbucks will calculate straight line each year amortization expense 19,178.07. So amortization expense debit, and they will the same amount they will reduce it or subtract it from their right of use asset. This is how the asset, they will reduce the asset, they will remove the asset gradually by depreciating or amortizing it. Now we will see how they will present it on the balance sheet. Remember, this is the balance sheet presentation at the end of the year. So at the end of the year, December 31st, they have this lease liability. If you remember that these liability, they will have these lease liabilities. If you remember, it is from your lease amortization schedule, and then you will see that the total liability portion was 75,179.24, and out of that they have to pay the second installment on the next day, January 1st, 2026. So they will show the immediate installment which is due in one day as current liability portion, and the remainder will be non-current liability. On the other hand, this is their asset. So right of use of asset at the beginning based on the lease liability amount, they recorded it, and first year they will subtract first year's amortization. So remainder value of that right of use asset is 76,712. How they will prepare their income statement and how they will show it. So this lease related interest expense, if you remember here and from your journal entry 3007.17, they will show as interest expense, and the amortization expense that you calculated here, they will show an amortization expense. So both are expense that will be in their income statement. Now next year they will make the second installment. Cash is gone at the beginning of the year, lease liability is also reduced. They will do the same process. They will again calculate the interest based on remaining liabilities. They will split the total lease payment between the interest expense and the reduction in the liability. They will show the remainder of the liabilities, and they will do the same process for the other 5 years, or for other like 4 years, 1 year just passed, and they will, this is how record Lessee all those journal entries based on the amortization schedule.